Welcome, everybody. My name is Joel Sinkin. I'm president of Transition Advisors. Those who've heard me speak before, I am still Freddie, and welcome back to Elm Street. Today's session, we're going to be focusing on mergers of accounting firms, and specifically how to avoid the most common roadblocks that people run into, and try and give you a little bit of a better understanding of certain aspects of today's marketplace. I'd never like to turn a CPE event into a sales session, but I do think it's important to get a little bit of an idea of the speaker so you understand their experiences and where their message comes from. For the last 24 years, the only thing I've done is help accounting firms in ownership transition. I've been involved in over 900 closings of accounting firms, ranging from mergers to acquisitions, succession plans, combinations of them all. I teach CPE for the AICPA, most of the state societies. And basically what we're going to kind of do with you today is try and give you a feel for all the things that we've seen go wrong, or not all, but a percent small, an amount of them, to try and help you avoid the same. These are just pictures of our team. I'll blow through them. Suffice it to say that I'm sure many of you recognize a lot of these names. We're all over the country, and this is what we do. Whenever you're facing a merger, and this is how I start almost every CPE class I've ever taught, if there's 50 things you need to understand about making this merger work, the smartest person in the room is going to only think of 35. And again, the reason for that is the uniqueness of each deal, the partners of the firm, the staff, the clients, the cultures of the firms. And while you can create parameters that you want to see things fall within, there's always those unique aspects that you need to address. So we're going to try and get you as much as we can. That's the quote-unquote norm in today's session. Let's start off with something that's really important, and that's understanding the simplicity, yet at the same time the complexity of why accounting firms merge together. I try and start with the simple approach, that there's two main reasons. One is a firm seeking to grow by combining another firm. It's a very quick, effective method of growth, and there's a lot of firms that use M&A as their primary tool to grow their firm. I don't think there's one top 100 firm in the country that hasn't gotten there by doing certain mergers and acquisitions. They may not call them all mergers. They may say, well, we've brought in partners. But if you're bringing in a partner with a $2 million book of business, I'll still kind of call that a merger. So the first type are firms looking to grow. The second type of merger is a more generic one. It's seeking to solve a problem. Now that always sounds like a negative. It's not always a negative. Some problems are good problems. Okay, let's give you an example of what I mean by seeking to solve a problem. We're three partners. Two of us want to slow down over the next 5 years, and the one that doesn't have the capacity to replace the two of us. So we need to merge in order to solve our long-term succession issue. We do a great job of litigation support, business valuations, expert testimony, forensic accounting. Hey, in that firm, if we could merge with a firm that has relationships with a lot of law firms, we could create a fabulous cross-selling environment. That's a good problem. It's a problem that we're seeking to cross-sell because we're very competent in something that we want to have more access to the people that would find it attractive. We could go on and on. But the purpose of us starting here is before you start a merger, you need to know the reasons you want to merge. Then you got to look at the other firm you're speaking to and know their reasons why they want to merge, and then make sure that we have a playing field that we can start the ball game on. I know that sounds very simple, but I have to tell you, as a consultant doing nothing but this for all these years, how many firms I've had reach out to me and say, hey, I'm interested in doing a merger. And when I ask them, what does that merger look like? I get a big duh. You know, sometimes because everybody else is doing it, you want to be involved in it. If you get Accounting Today, Journal of Accountancy, all these magazines, I write for most of them, every one of them has information and updates about M&A. So what happens is, it's kind of sexy, and everybody's saying, let's get involved in it. But you have to start with a very finite idea of what are the goals we're looking to achieve in order to get this process going. Now, one of the questions I get asked is, how come this firm got that firm? Sometimes you hear about a merger and you sit there and say, well, why didn't that firm come to me? They're right in my backyard. I do that niche. So sometimes an initial question I get about a roadblock, that sort of a roadblock you run into, is, how do I get in the door? How do I start the process of getting people to talk with me? Well, there's a couple of different approaches that you can utilize in an attempt to accomplish that goal. The first one is, look at the people you have a personal relationship with. Many accounting firms get to know each other. We're in the same community. We go to the CPE events together. We go to the trade shows together. We may even have certain clients that we share, where I do the audit, you do the tax. There's all different things, but at the end of the day, as infinite as the community feels at times, I also see how finite it really is and how many people know each other. And a great place to start is with people that you know. You know a firm. You know their 6 partners. You know 3 of them are over 59 years old. You know a firm that has a niche that you would love to have. It's a great way to start, is with people you've already have a relationship with. A lot of people will look to an intermediary as somebody who could kind of be a rainmaker of opportunities of practices. And there's a lot of different types of intermediaries. They're wonderful to use. Just know what their role is and what you can expect out of them in realistic. There's the broker, whose main role is really to get people to close a deal to get paid. And who pays them? That will tell you something about where their loyalty is. There's the consultant, who understands a little, maybe perhaps a little deeper of the relationships, and they may understand more about what your goals are and how another firm's goals might make sense for you. There's all different people that can open a door. I know some that have gone to someone who sold malpractice insurance and said, hey, I'm looking for this. You see, dealing with malpractice with so many clients, maybe you know someone who can address that. But the use of an intermediary can be a very effective tool in helping you identify firms that are worthy of a dialogue. It's a lot trickier, but what some people are always, or many firms are trying to do, is identify a firm that realizes they're in a selling mindset. Now let's define a selling mindset, because a lot of times when you hear that word sell, you're thinking of, oh, you mean, Joel, you're talking about a firm that the owner wants to sell the practice and go to Boca Raton and eat dinner at 4:30. No, not necessarily. A selling mindset might be, hey, I'm a $10 million firm, but I'm hitting my head against the ceiling. I got a lot more services. I got clients that are asking for than I have. I'm thinking maybe it's time I merge up. So a seller could be a large regional firm. It could be a small sole practitioner. But the point is, some of them are already committed to exploring the marketplace. Identifying them is tricky, but sometimes it can be done. Some firms I know have used an approach of almost making a generic offer out of the block to get someone to talk to you. Let me give you a great example. We recently did a special search that a firm who wasn't in Atlanta wanted to be. And with their permission, we identified the size firms and the nature firms and geographically, etc., that they were interested. And we reached out to them with an initial offer. Hey, we're working with a regional firm who's not in your area, and they're looking for someone who isn't looking necessarily to get out, who has talent in that office to become the managing partner of the Atlanta office as a division of a larger national firm. And they would never ask someone to put in the same time and effort and make less money. So they kind of outlined day one in a short paragraph or two what their goals and what their thinking is, and it kind of created an immediate foundation that either someone said, hey, that's worthy of a dialogue, or, you know, what has that got to do with me? But sometimes you make some sort of generic overview of what a deal might look like right off the bat to see if it makes sense. What's really been a new development over the last few years is a lot of accounting firms that are literally making their own marketing campaign, their own internal efforts to develop practice opportunities to merge with. Many of the managing partners of the top 100 firms consider one of the main aspects of their job identifying new firms, new partners, and clients to bring into their firm. And there's three main ways I've seen a lot of the managing partners of firms do this, whether they have a team under them or they're doing it themselves. Most of them will have a team under them that will start the process and then they'll pick it up. But one way is what we call a reach out and touch program. It's where John calls up George and says, George, you got to eat lunch, I got to eat lunch, let's eat lunch together. I got something I want to bounce off of you. It's literally just pulling someone out and saying, let's sit down and talk. I've also noticed at a lot of the semi-networking events, they could be CPE events, they could be trade shows, they don't have to just be a glorified networking event, where people are using it to reach out and say, hey, I'm looking to grow, I'm looking to bring in more talent, more niches, maybe we should talk. Kind of reminds me, a couple of years ago, on behalf of CCH, I was doing a CPE class on valuing an accounting firm and succession planning. And I noticed almost the whole audience was equally divided between the gray hair, who wanted to know how it would impact their plans, and the young talent that wanted to see who had the gray hair, who was coming to the class, and they got there early so they could try and sit next to them and use it as a network that, hey, you're here to hear about how to value practice. I'd love to talk to you about maybe working something out together. So I've seen that, and literally there was a regional firm in Connecticut that was the first one I remember to actually do it, that literally sent out a letter to a voluminous amount of local firms saying, hey, we're interested in growing. If you're interested in talking, we'd like to talk to you. So some firms are hoping and waiting for this practice to fall out of the sky and on their desk, and they're wondering how everybody's getting so active and getting this going. And then there are firms that are grabbing the bull by the horns and making it happen. And that's some of the ways that you'll see how to beat some of your competitors in the door. One of the most important things, though, is once you get in the door, there's a momentum to deals, and you have to move fast. Now, let's understand that when I say move fast, I don't mean I met you Tuesday, we should be closing Friday. What I mean by move fast is that you have to have an agenda. You want to have a sequence of events that you follow, that keep the momentum going, that keep us moving in a forward direction. Because we all have heard the story, time kills all deals. But have we heard enough about why, specifically in our world of M&A of accounting firms, does time kill all deals? Let me give you a couple of examples of what I'm referring to. First of all, if I'm a seller and you're a buyer, I want the most I can get, you want to pay the least. If I'm a mergee and you're a mergor, I want the most compensation I can get, the most perks and benefits. We're literally on opposite sides of the table when it comes to certain aspects of the deal, specifically some of the terms. Well, the longer two people negotiate, when you are basically on opposite sides of the table, the more likely it becomes adversarial. I can't tell you how many times I've had a client say to me, I don't care if they want dimes for nickels, one more change and I'm out of here. Or I've had clients say to me, Joel, tell them if I don't hear by January 1st, the deal's off the table. By the way, my response to them is, so it's a great deal if you do it December 30th, and it stinks if you do it January 2nd. If that's the case, don't do the deal. But the point is, you have to avoid these issues. Two other big reasons time kills all deals. Look, all of us have flaws. You can ask my wife and kids, they have an unabridged dictionary that big filled with my flaws. I can hide them in a couple of meetings. If we have 50 meetings, you're going to see a lot more of those flaws. And when you're in negotiations, for every 10 great things that happen, if one flaw comes out, you'll focus on that flaw. The longer you get to know someone, the more likely those flaws come out and can really jeopardize the momentum and the comfort level of a deal. But I want to give you the classic example of where time kills a deal in a very real story. We had a deal we were working on in our Texas office, and I remember getting a call October 6th or 7th of just this past year from the firm merging into the larger firm. This is a $7 million firm merging into a $30 million firm, but it could have been a $700,000 or a $70,000 merging into a larger. Don't get caught on the numbers. This is just examples. But what happened was this firm called me up and said, Joel, you know, I've been thinking that I haven't really discussed with that larger firm what their policies are when it comes to certain employee benefits and things like that. I'd really like to see their employee handbook so I could compare it to mine. So I called the managing partner of this $30+ million firm and I said to him, John, I just got this request. I'd like you to do me a favor and shoot me over by email the thing. And he says, well, you know, Joel, it's October 7th. We've got the October 15th deadline, like he's doing any of them. And then I'm going to go away for a week. So I'll get that to them around October 21st, 22nd, something like that. So I said to this managing partner, I said, let me ask you a question. Do you have any clients that pay you $100,000 a year or more? And he said, Joe, you know I do. I said, so if they called you on a question today that basically was a Word document sitting on your computer and all you had to do was attach it to an email, but you told them it would take you would tell them it's going to take 3 or 4 weeks to get it to them? His immediate response to me was, that was one of the most unfair statements you've ever said to me, Joel. How can you compare the two? I said, let me tell you how. The firm you're talking to is millions of dollars. They would be your biggest client. And what you're sending to them is one of two messages that they're going to take. Not me deliver it that way. They're going to assume one or two things. A, you're so busy, you can't get this to me for 3 weeks. If you're that busy, you're sure you can take on bringing our firm into you? Or the second message is, this isn't a priority to you. Which do you prefer them to get? See, time kills all deals because the most important thing on the firm merging up, the most important thing on their desk right now is the merger. The larger firm doesn't always look at it that way. And the minute the smaller firm feels this isn't the most important thing on their desk, you've got a problem. So let's talk about that sequence of events you can do to try and keep it moving, which is one of the biggest roadblocks, time. Usually I look at it in this 7-step type of process. We start with our introductory meeting. At our introductory meeting, and probably a little bit thereafter, in writing, we're going to share each other's goals. So at the meeting, I'm basically telling you what I'm looking for out of a merger. What is the professional? What is the financial? What are the aspects philosophically that I'm looking to accomplish in a merger? And we'll probably share that during our introductory meeting. After that, sharing of the goals, I'm probably going to suggest that we exchange certain generic information. Right at the very beginning of the process, let's exchange some generic. I'm not going to give you my clients' names and what fee I'm charging this firm and that, but I can give you a lot of information generically. Here's how much revenue I do, how much of it is business, how much of it's tax, what percentage I do that's audit, review, comp, what are my 5 biggest clients, what industries are they in, what revenues am I taking, what's my billing rate per staff or partner level, how's compensation work in our firm. There's certain fundamental information I should be exchanging with you day one. Why? Because when we look at each other's information, we might realize before we invest a lot more time that I'm in left field, you're in right field. This makes no sense. Conversely, we might see, hey, these are similar goals. This is similar metrics that I have that you have. Makes it even more comfortable. Now, once we've had these initial meeting or two, we've gotten a comfort level with each other, because if we don't have a comfort level, we shouldn't do the deal. But we have a comfort level. We've shared goals that make sense to each firm. We've shared and exchanged certain generic information. This may surprise you, but my next step, very often, is making a non-binding offer. Now that may sound strange. Two firms have met each other maybe twice. There's been absolutely no due diligence done. And Joel's sitting there saying we should make a non-binding offer. Well, let me share with you that when I first started doing this, it was 1990. And I had accountants, they'd have 3, 4, 5, 6 meetings with each other. Then they'd go in and do due diligence. And of course, we're an accounting firm. Either we billed it and collected or we didn't. There were very rare epiphanies in the due diligence. So the firm would go in and see everything was exactly what they said. Then they made an offer that nobody would have accepted anyway. What an inglorious waste of time. And isn't that the business we're in? We're in the business of how we apply our time. We don't have a product that we sell. When we're sleeping, someone isn't clicking a button and buying more monographs. All right? So how do we waste our time? What I'm saying is if we've shared our goals and we've shared enough generic information, I'm going to assume you're the Pope and everything you told me is the gospel truth. I want you to do the same. Let's make a non-binding offer of really how we start to see this coming together in a little more specificity than we did with just sharing goals. This is how comp works, profit distribution, what equity means. Put a real offer together. If it proves that you're in left field and I'm in right field, again, we know to stop the process. Conversely, if we find out that we are in a similar place, now it justifies due diligence. You see, due diligence is a lot. It's a big step. I've got to invest time in doing the due diligence. I've got to invest time in preparing the information you want to see of me. I've got to get non-disclosure agreements signed. I've got to somehow potentially explain to staff why you're looking in these files. There's a lot of issues here. Why are we taking the step of due diligence before we've even created a foundation that we agree makes sense? Now, also, prior to doing due diligence, what I like to do is I like each firm to exchange a list of what they'd like to see. We shouldn't be setting each other up for a search and destroy mission. We should be acknowledging exactly what we want to see in advance. And because, again, keep the momentum going, here's what I tell my firms once those lists are exchanged. Traditionally, there's 3 different aspects or categories, let's say, of due diligence. Category 1, things that are pretty readily available. Bank statements, P&L, certain things like that. Then there's certain things that take a little time to put together. And then there's certain things that you really can't look at unless you physically come to my office. Well, a lot of accounting firms say, well, let's get all 3 of these together and we'll start due diligence. No. This stuff's readily available. I'm going to get it to you, you get it to me. We're still okay? Then it pays to start putting in the time to put what we have to do together. And then the last step is when we come into each other's offices, because that's when there's always the risk of staff becoming more aware that something's going on. So now we've done our meetings, we've shared goals, we shared generic information, we made a non-binding offer, we've done a little bit of due diligence. Now we should sit down and say, okay, we seem to have an agreement. What's going to make the agreement work? Client and staff retention. So let's put together a transition plan. How do we announce this to the world? How is this going to impact clients and staff? What message do we both feel comfortable in sharing with the world that's going to make this happen? Well, if we've hit this stage now and we've completed successfully, all we have left is the documentation. We just simply document, we put together a document that memorializes what we've agreed to, and we execute it. So this is a map, a sequence that will help you avoid the biggest roadblock, time killing all deals, and put you on a path to getting to the place that's going to help you make a deal happen. Now, one of the biggest mistakes that I think a lot of the successor firms do, and this could be a 2-partner firm talking to a sole practitioner, this could be a national firm talking to a regional firm. As I mentioned earlier, the smaller firm, they are 100% focused on what's in it for me. Hey, I'm assuming you're going to be getting a reward. Matter of fact, most mergees or sellers overthink the reward that the other firm's going to get. But really what they're focused on is what's in it for me? Why would I give up my autonomy, control, and income? Why would I suddenly take everything I'm doing now and move it in with you? They're a lot less interested in why you're doing it. And quite frankly, when they start getting interested in it, sometimes it's a problem because then they start looking in your pocket. I've had clients say to me, you know, Joel, if I move in with them and we save on software and they get rid of some of my staff, they're going to make hundreds of thousands of dollars. I should get more for me. See, it's not what they get. You should be focused on what you're doing and what benefit it is for you. At the end of the day, if we're both not going to get benefits, neither of us are going to do the deal. But the successor firm doesn't realize how important of an issue this is. How sleepless some of the nights are once these dialogues can take place. And if they don't understand that, they're going to send that message that this isn't the most important thing on our plate, a big roadblock. Now, making sure your merger is going to work, there's 100 pieces of that puzzle that need to be put together. I think one of the most important starting points is to be absolutely clear with each other what our goals are. Maybe I'm a 4-partner firm and some of us are looking for succession, some of us are looking for growth. Maybe I'm a 20-partner firm and I'm located in Philadelphia and I really want to have an office in Bethesda, Maryland too, because I have some relationships but no feet on the ground. And if I could merge a firm there, it's a marketplace merger. I can then generate an office to grow from there. So these are important things. Be very clear right away what your goals are and then share what success looks like. Hey, these are our goals and this is what we think the benefit of those goals would be, and that's a very important step. And by doing that step, it very likely will promote each person to be not just focused on what's in it for them, but understand how each of us might be able to help the other. Because if we don't see that, once again, we're not going to get a deal done. And I think another roadblock people try to avoid instead of confronting is a little bit about the pain it's going to take to do a deal. I'm pretty sure it's Witham, Smith & Brown, a wonderful firm. And I think it was Bill Hagman, their managing partner, who said this to me, but I'm not 100% sure. I'm pretty sure. They use what they call a rip and replace strategy. When I merge you in, I'm going to assume unless your technology is exactly what we're using in software, we're just going to basically rip it out and replace it with what we do. And you know what? And I'm pretty sure it is Bill. He's very honest with the firm. If we're going to do a merger together, this is going to happen. Other people, and maybe that's why they're not as successful as Bill and Witham has been in mergers, don't want to put that on the table because they say, hey, that's going to be painful for them. I better try and make sure that they're so in love with us that by the time I bring this up, maybe I'll even close the deal and then bring it up. By the way, that's absolutely the worst thing you could do. Let's close the deal and then tell you about the pain I'm going to have to put you through. You got to be honest about it. You got to sit there and say what we're going to need to do day one, what we could do over time, and what we never have to change. Because this is going to tell both firms an awful lot about whether or not this merger is going to be a success. So let's talk about change. Let's talk about change, as I like to do, in 2 categories. Change behind the door, change in front of the door. Change behind the door. We change our software system from X to Y. Does that impact the client? No. We change from being paperless, from having paper to being paperless. Does that affect the client? No. But that affects staff? Yes. That affects partners? Yes. So if we're doing a merger and we're 2 small firms and we're not worried about staff for whatever reason, it's not relevant. If we're 2 bigger firms, that's some of the pain we might have to share day one. And again, we may not have to say that this has to be changed day one. I know certain firms that close a deal in December or January and elect to go through both if each of us had a different tax software, maybe this first year we're going to go through with each of us still using our old, and then in the off season convert into one. I've seen different strategies, but be honest with what you require. What do you have to do day one? What do you have time for? What never has to be done? Changes in front of the door need to be shared immediately because they're going to impact clients. Change in front of the door, it could be anything. It could be fees. The minimum 1040 price we get's 500. So anybody you have under 500, when they get the letter, they're going to be told it's going to be 500. Well, if I could have doubled someone's fee, I probably would have. That might scare me. That might not matter to me. All right? A change in front of the door is we used to go out to see our clients quarterly. Now they're all on the cloud, and we Skype with each other quarterly. Well, these are changes in front of the door that affect what? Not just the firm, but their clients. That's part of the pain you need to share right away. And a general rule of thumb is the more changes that you have to do to make a deal work, the less likely the deal's going to work. So one of the greatest roadblocks to avoid are firms that are going to require significant changes both in front and behind the door. They're going to expect those changes overnight, and those changes they expect are changes you feel will have a terrible impact on client and or staff retention. If these changes are going to be benefits to your clients and staff, it's okay. Going from one screen to 2 screens or 4 screens, a lot of staff are going to find at first maybe a drop intimidated, then saying, why weren't we doing this the whole time? So just because it's change, and change is a dirty word, doesn't mean it's a terrible change. But these are some of the critical points you need to do right away to make sure that we're on the same page if these changes are going to be expected to be made just as quickly. Now, one of the other things that I think a lot of people make mistakes with is going under the concept that bigger is better. Bigger is not always better. Better is better. And there are a lot of times bigger is better. If my client's already used to dealing with staff as well as partners, and they know staff's doing some of the work, and I could merge into a bigger firm that's also now going to add 4 more levels of service that I never had before. They do estate and trust, and they do elder care, and they do certain things I didn't do before, but it's a great addition to offer to my clients. And they're a bigger firm. This could be a wonderful thing. But sometimes the cultural and fee differences and everything could be too much to overcome. Right? If I'm a small sole practitioner, I have a whole bunch of small write-up tax clients that are used to dealing with me, and I'm going to retire in a year or 2, and I sell my firm to a big firm who's going to send out a junior to deal with clients that were always dealing with an owner. That's not going to work. If a client that was used to paying me $5 to $10 grand a year now is told the minimum fee is $15 grand, it's probably not going to work. That's where bigger isn't necessarily better. Better is better, right? The most dangerous merger that I think is to avoid are the mergers that people want to basically reduce overhead. I've given this example many times. I've had people say to me, Joel, you know what, I've got extra space, and if my secretary has time, so if I could bring in another firm, we could get rid of one of the secretaries, we could use one software, I have extra space, and we could create a lot of pure overhead synergies. I always say, is there any other reason for you to do that merger? If they say, no, that's the main reason and the only reason, I try and talk them out of doing a merger. A merger is a marriage. We spend more waking time with our partners than our spouse. Just to reduce overhead, I could accomplish that by renting some other accounting firm space. Share my secretary, share my software, but we don't have to be partners. When you're doing a merger, you need to have that specific goal like we said. Then we can identify targets that help us create structures that accomplish this plan. One of the things that I think a lot of the small regional and national firms are now getting better than they used to get is a lot of times they used to sit there and they'd say to someone, we're going to merge you in. And we're going to do you this favor of bringing you in, but you got to take less money now that you're coming into our firm. And the partner of the smaller, what do you mean? Well, we operate 1/3 labor, 1/3 overhead, 1/3 profit. You've got a $800,000 practice, you're making $450. Heck, I can't pay you $450 on 800. So basically what they're saying is, we want you to come into our firm, do everything the same as you're doing before. You're going to put in the same time and effort. You're going to bring in the same revenues, but you're going to make a lot less. Whether that's a partner or an employee, I'm telling that to, that's not a real compelling argument. So if you feel that that is your situation, that you cannot bring in a firm that doesn't meet certain metrics, don't have the dialogue with firms that don't meet that metric. But to expect someone to do the same thing that they've always done and do it for less is just an unrealistic expectation. In a marketplace that's so active right now, most likely there's someone that will give them the opportunity of more continuity than what you're bringing up. Right? Also, focus on what's the good fit. What are the right things we should be looking at? One of the articles we've attached today is The Great Mystery of Billing Rates. Another example I've taught in the past, where you have I had a $2 million firm down in Florida that had 2 equity partners that did all of the partner and senior and manager level chargeable hours. They were machines. They did a huge amount of the work. They had 5 juniors and like 3 paras. No managers, no seniors. They did all that level of the work themselves. The successor firm at first was saying, oh my God, they're only getting $200 an hour for partner time. We get $300 to $350, until we got them to understand that when the merger took place, the work that these partners in Florida are doing would be pushed down to seniors. And their seniors were only getting $150 an hour. Now they were going to get $200 an hour. But they looked at a piece of paper. This is their billing rate. This is their profit. And they make a decision that this is going to work or not work based on that. You can't look at other firms' billing rates and profit. You have to transpose it into your firm. Maybe it will take you less time and effort because of your technology to get work done. Maybe you could pass the work down. Maybe that firm's only netting 1/3 because the partner who was slowing down wasn't doing too much of the work anymore, and rather pay staff, have extra staff to give them quality of life. Does that mean you're not going to be able to streamline it into your firm? Maybe that firm's netting 50%, but you got to keep their space and you got to keep their critical staff, and you're going to not have any overhead redundancies that you save on, in which case you're not going to make enough to justify doing the deal. So stop looking at the pieces of paper and making a marriage based on that. Look deeper and transpose what the combined firm would look like, and see what that will do to the rates, what that will do to the profitability. And focus on some of the huge cultural differences. Here's a couple of them that may surprise you, the limited on this list, that have had a big impact on a lot of deals we've done. Partner billable hours. One of the trends that you tend to see, again, it's a trend, it doesn't mean it's 100%, larger firm usually has a lower amount of chargeable hours for partners. Not always. But I know a whole bunch of national and regional firms that partners might be doing somewhere between 900 and 1,200 chargeable hours. And then I know some small regional firms that if a partner doesn't do 1,500 chargeable hours, they're going to be hung, quartered, and dried. So, you've got to take a look at that. That could be a huge cultural difference in a firm that's going to make it very difficult to bring it together. Some firms have a size of book of business that each partner must manage in order to be a partner. Like, you can't be a partner if you're not managing $1 million book of business. But then you're talking to a 3-partner firm that they're doing $1.6 million, but obviously they're not doing $1 million per partner. And do you think they're going to, if they're a partner now, they're going to be willing to merge in and become a manager in your firm? Probably not. Some firms are very aggressive marketers, actually have a marketing department. Some find that to be distasteful. Kind of like some firms love wealth management, others think it's incorrect. I've had deals that became an issue because of dress code. That one firm was extremely casual, another was very formal. Billing, how they bill clients, could be a big part of culture. Some do it on retainers, not as many as there used to be. Some do it hourly. Some do value billing. What's kind of interesting, I'll tell you, that partner compensation, even though we'll talk in a minute about how you can overcome certain parts of it, can be a proxy for culture. A lot of times if the average partner at one firm is making 600 grand and at the other firm 300,000, it's going to be indicative of a lot of other things that are going to be more challenging to work out when we get together. And again, I keep using numbers of firms. It could be a sole practitioner and a two-partner firm talking to get together. But the sole practitioner is making 500,000 and the two-partner firm's making 200. It doesn't mean that one size has, the biggest size has always the good thing. Okay? It's just some of the things you need to think about, right? So these are some of the really important things you need to focus on in order to see where the cultural issues that aren't always looked at day one will come about. Are we an eat what you kill compensation system? Am I getting paid exclusively based on my book of business? And in another firm, there is no such thing as your client, my client. There's a one firm attitude. They're all firm clients. There's no such thing as eat what you kill. It's all about the firm. Those are very challenging cultures to bring together. These are things that you need to invest more time on. The metrics may be perfect. The metrics, the cross-selling opportunities, even our comfort level with each other might be absolutely perfect. But how are we going to get past the fact that our compensation's always been based on an eat what you kill, what business I develop, what business I bill, I get 40% or 30%, whatever. But in this firm, there's no such thing. Or in my firm, there is no time and billing system. In this firm, everything's time and billing. So again, the cultural aspects aren't the metrics. They're not the billing rates. They're not the cross-selling opportunities. It's how philosophically we operate internally and to our clients that are going to be impacted if someone else has a dramatically different way of going about it. It's one of the reasons you don't see too many mergers of equals. In the last few years, there's been a startling trend where there's been a couple of major firms, J.H. Cohen and Resnick, and there's several examples of them, Lawson Allen, etc. Those are unusual, but they were able to do it, and so far very successfully, because they had great culture matches. They had great leaders, strong leaders that brought them to where they had to be, not followers. People that demonstrated how to make this happen. But a lot of times mergers of equals is really challenging because there's certain cultural aspects that are very different. When there's a clear successor firm, it's clear what culture we're going to end up with. And the smaller firm gets to decide I can live with that culture or I can't. Mergers of equals becomes more complicated on a lot of levels, culture just being one of them. A couple other problems that you have to figure out how to get over are compensation. Again, is my buyout, for example, based on a multiple of comp or multiple of equity? A lot of smaller firms get a buyout based on a multiple times their equity interest. A lot of larger firms are buyouts based on a multiple of comp. How do we get past that? A lot of times what we'll create is a time frame where if a partner's getting out in the next 5 years, they can go with their original agreement. If you're going to be there more than 5 years, you've got to hitch your wagon to the way the successor firms are working. Average net income per partner. Let's say my firm was making 300 grand, your firm's making 5. That could be a problem. But maybe we create different levels of partners. Maybe there's a full partner, a junior partner, an income partner, a profit partner, okay? Many times in some firms, as I alluded to before, there's too many equity partners for the volume based on your other criteria. So if we have $2 million per partner, you have $500,000 in revenue per partner. That might be an issue, but it might only be an issue if equity is a powerful function. We teach a class on partnership agreements. You could come aboard and we can present to you right from this venue. And it tells you how some firms, equity does mean a lot. Equity impacts voting, compensation, profit distribution, buyouts. In other firms, equity means nothing. So what's the difference if I'm managing 500,000 or you're 2 million? A big obstacle that we've had to overcome a lot lately is mandatory retirement age. A lot of the larger firms have put in a mandatory retirement age because they want to make sure that it's attractive to young partners, that they know there's a light at the end of the tunnel. So maybe we have to allow some exceptions in the merger for people that are close to retirement. Maybe we do a two-stage deal. Another article that we've presented that you could take a peek at that basically keeps you whole in income, but you surrender your equity, but you defer your buyout. If you're not going to be an equity partner, but you're kept whole in income and you're still held out to the world as an equity partner, as long as your buyout doesn't have to start now because I can't pay you the same income and the purchase price at the same time, maybe it's a way to overcome it. Most mergers, an obstacle you have to deal with is capital contribution. We merge together January 1. How do we pay the rent? How do we pay the overhead? Usually each firm will contribute their AR WIP and create their capital accounts. But there could be timing to that. Maybe collecting my receivables takes a while. Maybe for you it doesn't. Right? There may be a taxable event. I've run into situations where it is a taxable event. For me to transfer my AR and WIP to you, how do you overcome it? Maybe I won't take my drawer for a little while and the drawer will become my capital account and I'll live off my AR and WIP. Right? A big obstacle is different compensations for the same roles. Could be staff. My seniors make 80, your seniors make 110. They're going to talk. You got to figure these things out. Again, there could be reasons we don't do the deal. And know what the biggest concerns of the smaller firm is. They're in control right now. They're giving it up. They don't want to become your clock punching employee. They want to know what's in it for them. They don't want to feel like a big fish in a small sea. They don't want you to put them in a position where their compensation is tied into the book of business and you're going to cherry pick their clients to get rid of a whole bunch of them. Some people get absurd about the name of the firm. If my name's not in the firm, I'm not going to be there. History has demonstrated your name is not as important as your relationship. And it's more the message you send than your name. Okay? I've heard many people, especially those who are looking for succession, say, hey, if I take this deal, all I have to do is work 4 more years. I make more money than that. Well, guess what? You always make more money working than retiring. So that's not a fair thing. The big thing that you need to remember, though, in roadblocks is for the mergee or the seller, it's much more of an emotional decision than a financial one. Nobody does deals to lose money. Figuring out the numbers is not usually brain surgery. Dealing with the emotions at hand, making people feel comfortable with change, that's a whole different thing. So, and on the internal buyouts, closing up, there's a couple of things to think about. Remember when we do a buyout, avoid the roadblock where the partner the partners buying out the senior partners should make more money. A roadblock in some partnership agreements in a merger is, hey, I just read the partnership agreement. When your 2 main partners retire, I'm going to make less money because their buyout exceeds how much their replacement labor and the cost of giving up their income was. Right? Make sure in your internals deal you have, in buyouts, you have notice to make sure you have time to transition people. That you're replacing not just a body count. We had 5 partners, 2 are retiring, we'll make up 2 more. But what role were those 2 partners doing? Right? Know if your clients are brand loyal or partner loyal. If they're loyal to the firm, it takes less time to transition. If they're loyal to the partner, give yourself more time to do it. Some people say you have to be a partner for until 65, and if you leave before that, you get paid less. Why? What if I put in 20 years and I became a partner at 38? Now I'm 58, I'm not allowed to retire? So a lot of firms are starting to look at vesting periods, having caps where your buyout can't exceed a certain percentage of the revenue to make sure the firm stays in good shape. More roadblocks to avoid. At the end of the day, I always start with the 50 things, and if you're the smartest guy in the room thinks of 35, I always end with the 4 C's. If you don't want to eat lunch with someone, don't merge with them. Biggest obstacle, make sure chemistry's there. Make sure we can give the right amount of continuity, that changes are going to be looked at as additions, not losses. Make sure our cultures make sense. Make sure we have the capacity to make this deal happen. That we have the capacity to replace people that we might be losing to retirement or what have you. Know the deal's got to work for everybody. The buyer, the seller, the mergee, the mergor, the clients, the staff, everybody. And remember, you got a lot to figure out. Just don't say, hey, this works financially without worrying about how it works philosophically. And the last thing is I get often asked about the role of attorneys. There's a lawyer who makes the deal, the lawyer who breaks the deal. To me, you're a CPA firm. You're the experts in numbers and all these things. You should be able to come up with your agreement, especially if you have a good consultant working with you, and understand the nature of the deal. The lawyer's job is to take what you've worked out and memorialize it in an agreement. The lawyer who wants to take over the negotiations or use the contract as a tool of negotiations is putting your deal in jeopardy. The lawyer that makes sure you're well protected in the draft, but the draft is based on what you've agreed to, that's the lawyer that's going to help make the deal. So these are some of the roadblocks you have to avoid. Take a look at some of the articles that we've provided for you today on more specificity about some of these roadblocks to make them aware of you. Jump on our website, transitionadvisors.com, where go to the resource section. You'll see case studies, white papers, free reports. Dig yourself in, help yourself to looking at them all. On the screen's our email address. You have any questions that we didn't address in this session you'd like to have more information on, shoot it over to us. We'll do the best we can to turn it around and give you those answers. Thank you so much. Have a great day today, and avoid those roadblocks.